Hey, it's Greg Rand, and this is a portfolio review of Cleveland, Ohio, 12930. Asking price 1.5 million and change, 24 occupied single family rentals. This is going to be a fun one because I'm going to use the occasion to show you a couple of the features that we have on the portfolio visualizer to help illustrate the opportunity and test a couple of assumptions. So here's how we go about trying to tell the story of a portfolio. It's a combination of the numbers and the market fundamentals. So here you have an asking price of $1.5 million. This is our yield calculator, and it assumes no mortgage balance. The monthly rent of $20,000 has a vacancy assumption of 5% of turnover. That gives us a gross yield of 15.8, which is awesome. Nationwide, that's among the highest that we see out there. There are reasons for that. We'll get into them. Taxes are actual. Management costs are an 8% management fee and a 10% maintenance reserve, getting us to a total expense load of 37.19, which is pretty responsible and reasonable. But I actually am going to increase it just because I want to even have this thing be a little bit more conservative. Let me keep going. Let me say I'm going to do $32,000 in maintenance. All right, good. So that puts me at a 40% expense load, which is an institutional level expense load, which means everything is accounted for. No place to hide. Net yield of 9.48, among the best in the entire country, so that's pretty awesome. But the rate of return is only 9.88. And what you need to know about the rate of return is that we just do a very simple combination of the net yield plus the average appreciation rate for this portfolio over the last 20 years. All right, I'm going to scroll all the way down here to show you that chart because it's a really interesting thing to try to project what might happen with price appreciation, or at least account for a responsible appreciation or lack thereof on a portfolio so you can see the full picture, because it isn't just yield you're going to get from this, it's also appreciation. And if you use some leverage on it, you're going to get an even higher rate of return. And we always go to this chart so I can point out to you that the blue line is the US, and you try to see if you can establish a trend line during calm seas. Okay, you see the boom and you see the correction. And what I always do is, I've been served very well by this analysis. Take a long-term view, establish a trend line, split if there's a peak and a trough, and then carry it forward. And that's where the market kind of wants to be, which is why I project that the United States overall is going to keep appreciating. All the market fundamentals support that theory, but this chart does as well. Okay, but different story in Cuyahoga County. This county appreciated a dismal 0.4% a year on average for the last 20 years. National average is 3.44. State average of Ohio was 1.42, and this is below. So this county right here shows a very, very slight appreciation during the calm times, not much of a real estate boom, a pretty nasty real estate correction that, as you can see, had very little to do with the real estate boom. It had to do with the erosion of the manufacturing industry that had been going on in that part of Ohio for a very long time. But here's the thing I want to point out. If you do research and if you pay attention to what's happening in Cleveland, what you know is that the job situation is improving. It's not happening overnight, but you've got an influx of manufacturing into the formerly strong manufacturing bases across the Midwest. And one of the things that I found fascinating about Cleveland when I spoke to people from the market who really knew it is that the erosion of the manufacturing base in Cleveland was, in Detroit they make cars, in Cleveland they made parts, okay? So call it door handles, right? They don't make the cars. It's very hard to repurpose a factory that was built for making cars into making something else. Not so hard to repurpose a factory that makes door handles into making something else, like, for example, medical instruments. And the medical manufacturing industry came in to a lot of those factories, were able to get in there for a song, repurposed a lot of the manufacturing workforce, and a lot of what eroded, not all of it, but a substantial enough amount of what eroded in Cleveland came back, at least partially. But Cleveland was also converted from a manufacturing economy to a service economy. So what you're beginning to see is appreciation based upon the overall lift of the economy right now. But look at this 3-year period is the steepest increase in value that we've seen since the very, very peak of their version of the housing boom, okay? And what I believe is happening here is that if you look at this line and you again carry the trend line forward before the volatility, you carry it forward, it would bring you all the way out here. I'm not saying that's where we're going to end up, But I am saying that this lift right here is real. I think it's going to continue. And over time, you'll look at this line and you'll see that this little juke right here was something that corrected itself. And I think we're going to see a better appreciation rate. So what does that mean? As I scroll back to the top in the calculator, we have visualization tools here for you to be able to project the cash flow increases based upon the increase in your rent that you assume and the increase in your expenses that you assume. You also get a chance to see the increase in investor equity. And as you can see, it's very modest because this is assuming the appreciation rate of 0.4% annually will continue. But I'm going to test something here. If I go back down again to this chart, I see the state of Ohio, which has also suffered some erosion of manufacturing jobs, has also rebounded, is looking at a 1.42% annual appreciation, again, compared to a 3.4. So less than half the national average. But for me, a kind of a reasonable assumption to say, if I think this is going to improve, if this is a 3-year trend that I think is going to continue, what number can I plug into the projections to correct this 0.4 that I think is history and give me a little more of a lucrative future? I'm going to use the 1.42. So back to the top. Okay. For purposes of comparison, I'm going to go out 10 years and say that my $1.5 million in value today, based on this modest appreciation rate, is going to be $1.6 million. Not a great 10-year appreciation. But let me change the 0.4 to 1.42 and then update my charts. Okay, the chart adjusts its scale, so it looks like it went down, but it didn't go down. Now my $1.5 million in equity up front 10 years later is $1.75 million. Okay, so what we want you doing is looking at the tea leaves, looking at macroeconomic trends on the market, and seeing that if you made some adjustments to things, what might you see happen in the future that would make this a great investment for you? Going back to the top, my yield of 9.48 is only a 10.9 now because I got a 1.42% increase every year, but that is still a big enough jump to put me into double digits. One last very quick thing that's great about the visualizer, I don't have any debt on this right now, but let me go to my down payment and say that I'm going to put a 35% down payment. Before I do, point of comparison, my net yield of 9.48 is of course identical to my cash on cash return because this calculator is set to assume it was an all cash purchase. So my NOI and my cash flow are the same, but not for long because I'm going to put in a 35% down payment, 65% LTV. And what I see now is that I've only outlaid $538,000 in cash to buy this now. I'm going to put a 6% loan on that. Now I still have my 9.48% net yield. That wouldn't change based on the debt, but now my cash on cash return is 13.72. And my overall rate of return is 15.14. Why? Because I'm borrowing at 6% and I'm yielding 9%. And that spread between yields and cost of capital is really, really favorable in a market like Cleveland. So my question is, okay, if I'm going to plunk down $500,000 and hope to get a 15% return on that when I account for my yield and my appreciation and my leverage, how does that play out? Oh, by the way, update charts. I can now see my cash flow change because I have debt, and I can now see my mortgage balance declining. And if I go out 10 years, really, really, really important fundamental of this asset class. Remember before I went from $1.5 million in invested capital to $1.75 million. I made $250,000. But now because I have this leveraged, I went in for $550,000 now, not $1.5 million. All right, the value was $1.5 million, but I only put down $550,000. 10 years later, I have equity of $908,000. I made $400,000 or $350,000 instead of $250,000. Now, how in the world did that happen when the property appreciated the same in both cases? Well, the answer is that my equity grows in two directions when I have debt. The top line goes up, the middle line goes down because I'm paying down principal. So over that 10-year period, instead of making $250,000 in equity, I made $350,000 in equity. Okay, and the one number we don't have for you yet, but we will soon, is the overall internal rate of return that balls together all of this stuff, bundles it into one number so you can compare an investment in Cleveland with any other kind of investment you might be thinking about. Let me go down to the market fundamentals because your question might be, do I want to invest in Cleveland? So now that I understand the numbers, Here's the mapping. You see some good clustering in and near the downtown. You can look at every individual property. These are not glamour shots. These are Google Street View images, all right? So this is totally transparent. Here's that price appreciation chart. Here's the population change. Now, here's where it gets a little touch and go. Do I want to invest in a place where almost everywhere in America the population is growing, and Cleveland it is not, okay? What are the things that are causing that kind of a long-term decline? Will it turn around? We don't know, and I'm not going to project that. I just want to reveal what the data shows. Outbound migration is the larger bar in every one of these things. But look, the outbound in 2005, since 2005, the outbound and the inbound, the gap is closing a little bit. Okay, not as much movement, and we don't have the more recent numbers here. We have to get them, but you see a trend of the spread between outbound and inbound migration is tightening at the very same time that the price appreciation was beginning to, the lagging price depreciation in the market is beginning to catch back up again. Unemployment rate is around the national average and the state average, but here's the thing I think is kind of cool, the job diversity chart. When you hear about a city that manufacturing erosion is the cause of its woes, you want to go look and see, okay, well, how big of a deal is manufacturing now? It's come back somewhat, but is the city still dependent on manufacturing? Is our manufacturing boost right now short-lived because of federal government pressure on companies to come back to the Midwest on top of tax cuts to encourage those companies to do that? Let's take a look. Number one job category is education and health services. Number two job category, trade, transport, and utilities. Number three, professional and business services. That's a good one to be number three. Government, number four. That's a good one to be number four. Meaning the further down government is and the further up business is, the better health a city's economy is going to be. And here, whenever you see business and professional ahead of government, it's a good thing. Manufacturing is all the way down here at 10%. So if manufacturing did erode in the future, you're less likely to see a repeat of history in Cleveland because it has detached itself from dependence on manufacturing. Okay? All right, so the next thing that I would normally do is go do some research and talk to people on the ground. We're going to have a conversation in a few minutes with the owner of this portfolio who identified the houses, acquired them, renovated them, and now is selling them, and he's going to give us some local flavor and a little bit of personality. Thanks for watching.